So I also want to add my thanks to Governor Julio Velarde and Mark Guzman for the fantastic organization of this conference and all the staff of the Central Bank of Peru. It's been wonderful to be here. I haven't managed to see much of Arequipa yet, but I'm hoping to stay for another day so I can. If anyone has strong recommendations, please tell me what I should do because it looks very beautiful. So thank you for organizing this and for inviting me to participate in this session. Before I go any further, this is the Welsh flag up here because Wales play Portugal this afternoon, and Powell is a Welsh name, so I'm supporting Wales even though I have to go back many generations to find any Welsh heritage in my family, but there must be some sometime because Powell means son of Hywel, so Hywel was definitely Welsh. Anyway, and that means come on Wales, roughly translated. So I was the last speaker, so I wasn't quite sure how to plan my talk, and I wanted to try to add value rather than just repeat things that were already said. And I do come from the IADB, so although these are strictly my own views, of course, and not those any official views at all here, I do have a, sort of more of an MDB kind of perspective, and I presume that's why the organizers probably wanted me in this panel. But I will say a few words on the global lender of last resort that we have just heard about in great detail. But I also want to focus on another issue which I think is part of the discussion as well, or it should be part of the discussion, which is actually to do with debt restructuring, which is kind of the other side of the coin, but I think it's an important element of whatever system is created or refined, and then talk briefly about the role of the MDBs, and I'll just make 2 points on the role of MDBs. I think in this discussion it's sort of very easy to talk in very abstract and general terms, and I think it's very important to sort of fix ideas about what we're actually talking about. So I always have this kind of timeline in mind, which for those of you who don't know me, although I'm British, I was the chief economist of the central bank in Argentina for 5 years in the 90s, as many of you know. So I'm probably a little bit influenced by that experience as well. So I think it's useful to sort of have a timeline in mind to fix ideas. Here I've called a fictional country Argentina, which you can probably guess, right? And so, we start off by something going bad in Argentina, which could be an external shock. It could be a global shock of some nature, but it's affecting this particular country. And of course, adjustment is always politically, and maybe this requires some fiscal or some other kind of adjustment, and that's always costly. So, often too little is done. So the country starts to lose market access. There may be some danger of a run. So there's a possible liquidity support. So the IMF and multilateral development banks, and I should say, whenever, I think, without Alejandro can correct me if I'm wrong, but I can't think of an IMF agreement in Latin America that did not involve the IDB and the World Bank's balance sheet as well. So the IMF and the multilateral development banks come in and provide liquidity support based on an agreed program. And of course, if that's successful, it's great, and that's wonderful. But sometimes it's not successful. And then there's this rather problematic question what to do. Should support carry on in the hope that it will be successful in the future? And that raises the issue that Eduardo said I was going to focus on, which I'm not, but anyway, of moral hazard. Or should they exit, in which case provoking a crisis and likely a debt restructuring, as we've seen in several cases in the region. So this is the kind of timeline that I have sort of in the back of my mind. And I think it's very important to have this possible sequence of events in mind when we're talking about the financial architecture, and otherwise we sometimes get lost in a bit of the abstract. And I'm going to go a little bit further and introduce a little bit of game theory here, which does involve kind of moral hazard. So, I think let's just say that the international financial institutions could offer either unconditional support or no support. And let's say that the country has a choice between, we could call it adjustment or no adjustment, or we could call it a safer strategy or a riskier strategy, or some difference that the IFIs don't necessarily, one which is viewed as safer and another strategy which is viewed as a bit more risky. And most people would agree that the first best would be where the IFIs offer conditional support and the country is doing whatever the reasonable adjustment program is in place. But if the IFIs do offer unconditional support, then Argentina's incentives may well differ from that, and there may well be an incentive to move to that top right-hand quadrant. And of course, if the country does move to that top right-hand quadrant, then now the IFIs are less happy about providing unconditional support, so they may actually prefer to offer no support. But then if the IFIs are offering no support, then actually the country may have to adjust. The markets may force the country to adjust. But then, of course, if the country is following that adjustment process, then there's no reason why the IFI should not support. And so there is no, this is a little, very simple 2-by-2 game in what's called pure strategies. But the interesting thing is that there's no equilibrium in this game in pure strategies. There is actually an equilibrium in mixed strategies. So that's where the the IFIs may offer unconditional support, or they may not, with some probabilities, and where the country is pursuing that reasonable strategy with some probabilities. And my depiction of Argentina 2001 is precisely that. You were never quite sure whether the IMF agreement was in place, and you were never quite sure whether Argentina was adjusting as it should. And I think one can see that in some other places. But I don't want to get too depressed about this, because there are many things that one can do, and I think that's where we should focus, because if that underlying one-shot game in pure strategies has no underlying equilibrium, then we need to really think about the ways in which we can get to that first best. And that basically means either trying to introduce some kinds of commitments, so that could be some kind of conditionality, which may work to some degree. I'm a bit suspicious about whether typical conditionality works, but there may be other kinds of commitments that can be made. There are ex-ante rules like the ones underlying the FCL and other kinds of facilities, which is a way, in a sense, of providing commitments so then the IFIs can respond with unconditional support. And also there's repeated interactions basically to gain trust and to promote cooperation, which we know that in repeated games may further cooperation and hence the first best. And in that particular sphere, I think the multilateral development banks may have some further role to play, because, of course, it's the multilateral development banks that have the continual lending relationship with countries, and so perhaps can play an important role in that process. But perhaps there are other ways that can also develop either carrots or sticks to enhance the possibilities of creating cooperation in that game to get away from that underlying problem of no equilibrium. And I think that's sort of where the focus of the discussion should be, on what are the ways in which cooperation can be developed so we get to that sort of first best outcome. Now, countries, of course, can take other actions, and they have been doing so, and there's been a lot of discussion about building up reserves. I always thought reserves were sort of a individual country response, so I'm not even sure that we should think of them in terms of the global financial safety net, because they're an individual response by individual countries and tend to be used in an individual way. So I haven't actually included them here, unless, of course, you're prepared to share reserves in some way. The multilateral development banks, as I come from one, we also have our own contingent facilities, which the IDB has. One can get a kind of FCL, if you like, from the IDB, and there are a couple of countries in the region that have them, essentially like a policy-based loan, budget support loan, which is not drawn down in the first instance and can be drawn down at any point in the future or subject to some triggers. We've had a lot of discussion already about the regional arrangements and swap lines. There's also been in the history development of private lender of last resorts, which actually have been completely automatic, so Eduardo should like them, and Argentina actually has an interesting history, I would claim, with partial success. So I think actually that it's worth reviewing some of the experience there. And then there are other responses, which is essentially a way of, trying to get yourself out of the need for international lender of last resort through essentially relying more on domestic markets and so forth. Sorry, I've got a strange message here. My battery is about to run out. Okay, there we go. Okay. But I think one of the problems, as I mentioned before, developing sticks and carrots, one of the problems I think has been on the side of the sticks, and that has been the system for debt restructuring. So the way I think about it is the following, that if the path for debt restructuring is clear and the outcomes are predictable, then that threat, if you like, of the IFIs not providing support or exiting at some point becomes more credible. And game theory is full of all sorts of counterintuitive ideas. So if that is more credible, actually may be less likely to happen. You may then get more to the first best. And that was my understanding always of the proposal of the SDRM. The proposal of the SDRM was to allow for a more of a predictable path for countries to follow if at some point the IFIs decided that they had to withdraw their support, and by its existence, it may make that route then less likely. But I would argue that the system we've had has neither been clear nor predictable, and so we probably need to still continue to think on those mechanisms. Let me just give you a couple of graphs to illustrate. This is a graph of the haircuts that have been in a whole set of debt restructurings in recent history. This comes from the data set put together by Juan Cruces and Christoph Treves. And as you can see, there are sort of two peaks. There is one peak that low haircuts, and they've actually been the most popular form of debt restructuring. And then there's a second peak which has been much deeper restructurings, so deeper haircuts in terms of present value, but very few, relatively few of them. The IMF in recent papers has labeled these as reprofilings and restructuring. So I'm going to use their language to refer to the first type as reprofilings and the second type as restructurings, where reprofilings are likely zero principal haircuts, often preemptive, and low present value haircuts, as I said, whereas restructurings probably include a principal reduction, often ex post, and much larger haircuts. The second fact that I draw your attention to is that there have been many, many multiple debt restructurings. So if you look at, if you organize that data set by country and you look at countries that have had successive debt renegotiations, let's call them, then you can look at a set of what we call final restructuring. So final restructuring is essentially, or final renegotiation, let's call it to be more general. A final renegotiation is one which apparently solves the problem because there is no subsequent renegotiation in a period of time. That is how we define it here. And so there are a number of countries, the one, or a number of cases of final restructurings in one, which did not involve multiple restructurings, but there's a whole sequence of final restructurings that involved previous restructurings, and sometimes several, up to 5, 6, 7, 8 different types of renegotiations until a final one. The third fact is that the haircut in these final restructurings tends to be much larger than in any restructuring which is not final. And the conditional probability of a subsequent restructuring is higher, the lower is the haircut in a first restructuring. So there are many multiple, and if one organizes the data set according to reprofilings and restructurings, there are many cases of multiple reprofilings. There's very few cases of multiple restructurings, and there's a few reprofilings followed by restructurings. But there are many cases of multiple reprofilings. I'm sure you can think of some. And final fact, debt renegotiations have not tended to reduce debt to GDP at all. This is, again, using the same data set and using total public debt over GDP. And if one divides that into reprofilings and restructurings, it's only restructurings that have lowered debt to GDP, and reprofilings, if anything, have increased debt to GDP. And I think I ran out of battery. Is it not plugged in? So let me just try to summarize while we're getting the computer back on board. So adding this up, basically what my interpretation of this is that countries kind of face a choice. They either go for a light reprofiling, which case they risk subsequent reprofilings being very likely, or they go for a deeper restructuring, which may solve the underlying problem but may be much more costly. And that, I think, has typified the kind of choice set that countries have had, given the system, in inverted commas, for debt restructuring that we have had. and that these reprofilings have then, the multiple reprofilings have meant that countries remain with very high debts. The debt problem does not tend to go away until there's some other thing that happens which allows them to exit that unfortunate situation. So, and I think this has not been unrelated to the system for debt restructuring. So I think the way in which the ad hoc system that we've had for restructuring debts has basically pushed countries into that sort of bimodal choice. Most countries do not want to risk legal problems arising, and hence they go for reprofilings, but risk subsequent reprofilings. In other words, they do too little in terms of the debt renegotiation. Now there's been big changes in this, given new contracts that have been introduced. So these new collective action clauses imply a very potentially significant change. But it's very hard to tell what this new era is going to look like until we have real cases. So I think I think up till now we have had anything but a clear and predictable path. And as I said, I think this is critically related to the system for the safety net, because unless we do have a good system which provides a clear and predictable path, then I think it becomes very problematic to provide sticks and carrots to get cooperation to allow that first best to develop in the global financial safety net. So I think we're in a sort of uncertain territory at the moment where we don't know if this new world is going to provide this clear and predictable path or whether further innovations are required. But I think it's something that we should still keep and maintain on our agenda. Finally, let me just say two things about the role of multilateral development banks. So the first one is that MDBs really tend to be the trigger for IMF involvement. But the rules of the game here probably could be clearer, and I'll come back to both of these. And the second is a point that was raised yesterday by Alejandro, which is MDBs in history have been quite counter-cyclical, especially if you look at relative to private flows, which are highly pro-cyclical. And we did some work on that at the IADB in our flagship in 2007 that was called Living with Debt. But this role is becoming increasingly difficult, and so I'll explain that. On the first point, IDB governors have said that the IDB can only extend budget support to countries that are sustainable macro, and I presume the other MDBs have some kind of similar types of rules. And so if the fundamentals in a country worsen, at some point the IDB must cease budget support. And this has often, in this region at least, been the trigger for then an IMF agreement or debt restructuring or both. Now, I think that has created some interesting issues. And so while respecting the IDB's different governance structure, I think very close information sharing, joint missions and early meaningful discussions are extremely useful between the IFIs. Now this is happening in a more sort of informal way, but I think there may be arguments for increasing the formality of these kind of procedures and making the rules of the game here also a bit more formal and clearer as a way of strengthening the processes in this direction. And on the second point, let me I'll finish with this. So MDBs have been highly counter-cyclical, basically based on excess capacity. So particularly at the IDB in the past, we've always had a kind of reserve that has been there for emergency facilities and so forth, which has been used time and time again. We don't actually have that at the moment. It was eliminated. We may bring it back. We're not sure. And we've also basically gone to recapitalizations when needed. Particularly in the last in response to the global financial crisis and the demands from countries in the region following those events. And I think what's critical here is also the IDB's preferred creditor status, or MDB's preferred creditor status in more generally. That only if you have preferred creditor status can you be truly counter-cyclical while private markets are pro-cyclical. We can come back to that point in the discussion. I don't have time to really elaborate on it at the moment. But what we've seen happening is basically MDB excess capacity has waned. This is not just the IDB, but other multilateral development banks as well. And rating agencies have shifted a bit their methodologies and particularly Standard & Poor's, which should be, in a way, congratulated for making their procedures more transparent. So S&P has gone the furthest in making its methodology of how it rates multilateral development banks more transparent. But in that new methodology, tends to give very little benefit, I would argue, for preferred creditor status. It also gives a very high cost to for regional development banks, given their regional concentration, so what's called the single name concentration risk. So in a recent paper, which has just gone up on our website, that I wrote with William Peridin and one of his colleagues, we model IADB credit risk basically, and look at the different ways of modeling preferred creditor status, and our bottom line result is basically that our board and our governors have said that we should maintain our AAA rating, and to do that, given data at the end of 2014, according to S&P, we needed more than $30 billion of capital, but according to our estimates, with a different way of benchmarking preferred creditor status, we would need about $15 billion. So that gives you sort of a bit of the order of magnitude. It's basically the preferred creditor status and the concentration risk together basically means that we need to hold double the amount of capital that our benchmark model would give. And so this is at one point in time, but if one did some kind of simulation over time with the region, countries losing or their credit ratings worsening, then this would very, very strongly affect our ability to be counter-cyclical, or to accompany the IMF in a subsequent IMF agreements to using MDB balance sheets if they were required. So I think to conclude, I think continuing thinking on ILOR is required, especially to try to find the ways to enhance this more cooperative approach. I do think it's tied to having a good system for debt restructuring as well, which we're still in an uncertain world there. I think we can do more on IFI cooperation, and MDBs are highly constrained. I'll stop there. Thank you.
Thank you, Andrew.